Welcome to the KPC Smart Money Podcast with Kevin and Karen Chris. So today we're going to talk about something we haven't talked about in a while. And the subject is IRAs or ticking tax time bomb. Now, there's a guy named Ed Slott that's a CPA that he's done shows on PBS, and he actually came to he was a keynote speaker at one of the conventions we went to 8 or 9 years ago. Do you remember that?
Oh, I do. He's one of the best guys out there when it comes to talking about taxes. Yeah.
Well, look, let's face it. It would almost be malpractice for any financial or tax advisor to ignore the coming tax storm. So what we mean by that is we see a lot of people, Karen, that are coming into our office that the bulk of their nest egg or savings is 401k and IRA, right? If you've got money in 401k, eventually you're going to roll that into an IRA, right? And so we want to talk a little bit about that. So talk about a little bit about this tax time bomb. What are we talking about here, Karen?
Yeah, so, Ed Slott, he likes to say it's to help people prepare for the tax storm now before it unleashes financial damage in the form of excessive and unnecessary taxes. And your advisor needs to be talking to you about taxes. And so in Ed's book, he calls this the ticking tax time bomb. And what he talks about is the biggest check that you're probably ever going to get. And what he's talking about is while you're working, if you have been accumulating a big 401k in particular, when you leave that job or when you retire, well, you're going to take it out of that 401k, and that's probably the biggest check you're ever going to get, is that distribution from your retirement savings. And you know what? In some cases, do you know that check is probably bigger than a lot of people's home value?
We've had people that have brought their 401k checks that were $700,000, and it was a check sent in regular mail.
Yeah,
not a mind blower.
It is.
They worked all their life. One guy, if you remember, it was sent to his house, and it was left on his porch.
Yeah,
and we had a storm. And it got into the FedEx package, and he took a picture. The check was all like
wetted, yeah.
Almost $800,000.
His entire retirement account, right? Exactly.
Yeah, right.
But this is for a lot of people. It's a once in a lifetime decision, and you want to be doing it right because you're about to retire. So if you only got one chance to get this right, you don't want to suffer adverse tax consequences by making a mistake.
Yeah. So Karen, people ask, well, okay, I'm going to retire. I got this big giant 401k. I've been avoiding tax, my whole career, right? What do I do? Do I roll over? Do I roll it over? Do I stay put? Can I just leave it in the 401k? Should I withdraw it or should I convert it? Right? Those are the choices, right?
They are.
Okay.
Yeah. And so again, big decision, and you need to know the impact and the options. In fact, we're all held by a DOL rule where anybody who is thinking about
Department of Labor.
Again, lots of rules, but what was it? It's their rule book on this subject alone is like 480 pages long. They're serious. You need to know what your options are before you make that decision. So, we talk about this all the time. I'm really happy to see Ed Slott come out and say he's worried about it too. But anyone with an IRA or a 401k should be worried about future higher taxes as our national debt keeps increasing. At some point, maybe sooner than we think, Congress will be desperately seeking revenue. Well, where do you think they're going to look? And that's easy. Congress will go for the low-hanging fruit, retirement funds that have not yet been taxed. They're sitting ducks, and at some point, tax rates will have to increase.
Well, think about this. As people's IRAs and other retirement account balances grow, so does the tax bill within them, because these funds are only tax deferred. not tax-free. So your IRA is an IOU to the IRS.
Yep, that's what I like to say. If you've got a 401k or IRA, the IRS or Uncle Sam owns a piece of that. And you know what? With the tax laws changing all the time, you don't even know how big of a piece he owes or that he owns. It's terrible. So again, these funds have not been taxed yet, but they will be, and likely at a higher tax rate or on higher balances, leaving people with less when they will need it the most in retirement. The taxes growing in the IRAs is what we call, and what Ed Slott calls, the ticking tax time bomb.
Okay, so it's not if, but when, right, Karen?
Yeah.
These taxes will have to be paid, and the longer people wait to address them, the bigger the tax problem grows. Current tax rates right now are at an all-time historic low.
Yeah, you know, Kevin, when I do the retirement seminar, I show a chart of historical tax rates, and you know, it wasn't that long ago where tax rates were quite high. And
Yeah.
what was it? Who quit working?
Ronald Reagan.
Ronald Reagan. Yeah. Reagan quit working halfway through the year.
That's when he was an actor.
That's when he was an actor.
Long time ago.
Because if he worked more than 6 months, 100% of his taxes were either going to the federal government or California.
That's right.
So he just stopped working.
Yeah. That just shouldn't happen, should it?
No, but it has.
I got to tell you, Karen, I thought this over my career. The business starts to grow and you start making more money and you get hit with all these other taxes and just more and more, and the government starts taking, and you think, why? The better I do, the more they take. It's unbelievable. So we have to protect ourselves against that. So when it comes to the tax time bomb, we've got to do something proactive before it's too late.
Well, absolutely. And, there's been a lot of changes to the tax laws recently, and IRAs have become the absolute worst assets to leave to beneficiaries. That wasn't true a few years ago. Before 2020, you could do something called a stretch IRA that allowed beneficiaries to extend RMDs, or these distributions from inherited IRAs, over their lifetimes, which, depending on their ages, it could have been 30, 40, or 50 more years of tax deferral and the ability for these accounts to grow. Well, not anymore.
Nope.
Yep. Congress, in their search for revenue, eliminated this benefit that many counted on when making their plans years ago.
So the Secure Act eliminated the stretch IRA, right?
Mm-hmm.
And that's for most beneficiaries, and replaced that with a 10-year rule requiring the inherited IRA funds to be withdrawn by the end of the 10th year after death. Uncle Sugar wants his money sooner. That's what that says.
Mm-hmm.
Shortening the window of total taxation, generally resulting in higher taxes, which may fall on beneficiaries who would be in their highest earning year. So think that. You die and you leave money to kids that are in their 60s that are making the most money they're ever going to make.
Right.
And so the money they have to take out of your IRA, your old IRA, sits on top of their income, thereby them having to pay a lot more tax.
Yeah. So, Congress closed that door, but some other ones opened. IRAs are always a problem asset to inherit because, one, the rules are complex and they are rigid. Even the stretch IRA could be lost if you didn't do it just right. So while Congress downgraded IRAs as wealth transfer or estate planning vehicles, they indirectly upgraded solutions like Roth IRAs and life insurance as more powerful estate planning vehicles.
Yeah, Karen, you did that with your 10 years ago.
I did.
You started putting money into a life insurance plan that had the lowest possible death benefit that you could take, thereby piling in cash that you can take out tax-free later, right?
Yes, you have to keep me around. It's got more cash value than death benefit.
That's right. You don't want to be worth more money dead than alive, right?
Right. But it's a fabulous estate vehicle, So we agree with Ed Slott. We talk about this all the time. It's time to start reducing those IRA balances, and you've got to leverage those funds in tax-free accounts because we say it again and again and again. In a tax-free account, you're compounding what you're earning on it. You get to keep 100% of it, and so does your family because you've kicked the IRS out of your retirement.
Yeah, so even after paying taxes now, clients and their beneficiaries will end up with a larger inheritance, more control, no more complicated IRA tax rules to worry about, and less tax. This is what every client we've ever talked to has wanted.
Yep. So again, today's historically low rates, they're going December 31st, 2025, provide the opportunity to move some of those IRA funds to tax-free territory, and you can get rid of your ticking tax time bomb now. So that's our show. We've enjoyed talking to you. And, if you've got questions about these tax Roth conversions, cash value life insurance, or any of that, just give us a call, 877-KPC plan, or go visit us at kpcfinancialsolutions.com. We'd love to hear from you.
KPC Financial Solutions is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through KPC Financial Solutions, LLC, a registered investment company. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying ability of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should be construed as advice designed to meet the particular needs of an individual's situation. KPC Financial Solutions is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by KPC Financial Solutions. Hypothetical examples have been provided for illustrative purposes only. It does not represent a real-life scenario and should not be construed as advice designed to meet the particular needs of an individual's situation.